I reposted on Fit Credit Doctor, which is my Instagram, Realtor.com's post, which was, you are now going to be able to receive a mortgage much easier now because they're going to be including your rental history and leaving out the rest of really what's going on. So obviously headlines sell. I totally get it. But this is one of the reasons I do what I do, is because so many people are misled. Half of the truth is not the truth. And let's be real, how many people are actually going to click on the full read and decipher for themselves like what this actually means? I feel like most people are going to flood the market and say, oh, yay, I'm gonna go buy a house, and just start applying for things, not understanding what they are. Hello, everyone. I am Micah Smith, and I am so excited to be back with another episode of Rebuild and Rise. I rushed into the studio today for all of you because yesterday, mortgage news, real estate news was lit up. Like, everybody was like, oh my God, what's going on? So I come to you with the facts as far as what's going on. So literally, the internet broke yesterday. Everyone's reposting, sharing. Everyone has an opinion about this mortgage announcement that was actually dropped yesterday. So I want to talk about it because that's what I do. So last year, in November of 2025, I actually talked to Fox Business about Vantage and FICO 10T, the newer mortgage algorithms that are dropped and haven't been implemented yet until just yesterday. So I was talking about it before this was a super hot trending topic. And so I want to break it all down. I want to break down the history, the models, what it means for you as a consumer, as a lender, right? And I want you to know if your lender is even adopting the newest mortgage algorithm, which is what it is that's being talked about. So yesterday, I reposted on Fit Credit Doctor, which is my Instagram. I had reposted Realtor.com's post, which was, you are now going to be able to receive a mortgage much easier now because they're going to be including your rental history and leaving out the rest of really what's going on. So obviously headlines sell. I totally get it. But this is one of the reasons I do what I do, is because so many people are misled. Half of the truth is not the truth. And let's be real, how many people are actually going to click on the full read and decipher for themselves like what this actually means? I feel like most people are going to flood the market and say, oh, yay, I'm going to go buy a house, and just start applying for things, not understanding what they are. So let's break it all down. So let me give you the timeline, because nobody's really talking about the timeline right now, and context is really everything. So in 2018, what happened is the Credit Score Competition Act, yes, it's a thing, was signed into law. So that law directed the FHFA. So what is the FHFA? It's the Federal Housing Finance Agency. Now, what they do is they oversee Fannie Mae and Freddie Mac. And so what they do is they actually establish a process for validating and approving more advanced scoring models for mortgage underwriting. The government said we need more competition in credit scoring. They've simply said that FICO has had the monopoly long enough. So fast forward to 2022. So what they did was FHFA, they validated two brand new models, which was Vantage 4.0 and FICO 10T. So I've actually been talking about this pretty much since 2022. So if you scroll down through my Instagram, you will see some very old posts that actually talk about the introduction of the newer mortgage algorithms. So they started testing them, they started reviewing them, and they're like, cool, these are approved, we're going to move forward. But understanding that approval validation doesn't mean implemented. And so there's a difference between a law being passed and then the regulations being written to actually enforce it. So what happened is July of last year came, and Bill Pulte, who is the FHFA director, what he said was lenders can actually start using VantageScore 4.0. So How exciting. So here's the thing though, the infrastructure still wasn't in place. It is a massive undertaking for a mortgage company to adopt a new algorithm, right? So what they had to do is they had to wait on pricing grids and technology updates and delivery guidelines. So here's what happened yesterday, April 22nd of 2026. I'm recording April 23rd. Okay. So Fannie Mae and Freddie Mac, what they did was they updated their selling guidelines officially. So that's the rule book that tells lenders exactly how to originate and actually deliver the loan, excuse me. So what happened is yesterday everything became real. And so that's why the news yesterday went bonkers, even though I have known about this for literally the last 3.5 years. And so the crazy thing is most LOs, most banks, literally, I don't know if there's any realtors that knew about this. So they were on fire, like, oh my gosh, like, what does this mean? Like, I even saw people talking online, like, what's going to happen to the mortgage industry? Tell me the mortgage industry isn't in trouble without saying it's in trouble. Like, there is so much nonsense being posted. And I actually got kind of caught up and I was like trying to respond to as much as I could. I'm like, guys, here's the link. This is what I talked about. It's very simple. It's a new algorithm. That's all that it is. So let's actually talk about the models themselves, because this is actually where a lot of people really get confused. And most industry professionals, listen, that's what I do is I teach all over the country as far as how this works, professionals and their clients, because everybody is getting it wrong. It's not their job to know credit. And here's what you need to understand as a consumer. It is not your lender's job to know credit, okay? It's not something that they have to get an A++ in order to be a lender. Their job is to get you into a home, to qualify you accordingly, and you want the home at a 500 credit score. If they can get it for you, they're going to get it for you. So understand their job is not to help you maximize your credit score. Their job is to get you approved. So let's talk about the algorithms themselves. So FICO algorithms that have been used for quite some time, they've been in circulation. They've been used since 1989. Okay, that's a really long time. It's like almost as old as me, not quite. And so they've been running on these traditional algorithms. And so they're extremely antiquated. And so the thing is, with these algorithms, they're a little bit older. They don't take into account automatically if you've been paying rent for a certain number of years or if you've been paying utilities for a certain amount of time. So it's really making decisions based off of the data I've been teaching for 12 years, which is traditional good habits, right? So there's only certain things that are reported to credit. And so here's what's happening now is, so we enter the new era, right? Obviously, government stepped in. And so they said, okay, let's make Vantage a contender. So up until now, Vantage and FICO, right? Two different worlds. So Vantage up until now has never been a player in the mortgage industry. So right now, with the approval to be in the mortgage industry, this means essentially that this algorithm is designed to be, simply put, just it's more inclusive. Okay. So what happens with these VantageScore 4.0 models is things that typically never showed on a credit report are going to show now. So things like rental history, utilities. So really it's just alternative data, if that makes sense. So things that show financial responsibility that never showed up on a traditional credit report prior are now going to be incorporated. So what's really cool is this actually is going to be using machine learning to build a more complete forward-looking picture of who you are as a borrower. So again, this machine learning is next level, and I can't get into that on this podcast, but what's being incorporated now is, they've always said it in my classes, I talk about the damage that is done to someone's credit when they make one mistake and they've been perfect their whole lives. It's extremely detrimental. And so we're hoping to see not only more inclusivity, right, where more people are going to receive credit scores. And in fact, to give you the number, they're saying that roughly about 33 million more Americans under this new model should be able to receive a mortgage score. So under the traditional scoring models, what you would see is that you wouldn't actually get a credit score until you've had at least a minimum of 6 months of payment history under like a credit card or a major type of trade line. And so now you might have 1 month payment history and you'll have rent history and utilities, and all of that will show up in the credit report. And here's the one thing to remember, however, the number one factors are always going to be payment history, utilization on credit cards, revolving trade lines, store cards, credit cards, lines of credit. That does not change, whether it's Vantage or FICO. It does not matter. Those principles remain the same. So what I've been teaching this entire time is still going to apply. You still want to focus on building these good habits that ultimately are going to carry your credit score, right? Because again, revolving trade lines, it's the only type of trade line that, right, you keep it open indefinitely. So, right, you pay it off. Let's just say you move out of your rental unit, right? It's paid off, it's closed, it no longer calculates into the credit score. Sure, it'll show up in the credit report as positive history, right? But it's no longer calculating into the score, which is the importance of, again, building what we would call timeless habits. So just remember, right, traditional habits still apply. So 30% of your entire credit score comes from how you manage your credit cards, 35% being payment history. Again, do not miss a payment. For the love of Pete, I teach this in all of my classes. This is still going to be detrimental to you because it's still the number one factor that lenders look at to determine your eligibility. So you need to understand, if you miss a payment, it's not a big deal. Missing a payment is catastrophic, because essentially, understand, what is credit. Credit is, they're trying to determine your likelihood of default. So the riskier that you look on paper and the more likely you look like you're going to default, the more expensive everything is going to be. So you need to understand that you still have to build those timeless habits. So just because a new algorithm was adopted, that doesn't mean that all of these old principles that I've been teaching for the last 12 years don't apply. Same thing applies. It's just that now people who were not visible will be visible, which is pretty cool if you ask me. So what's going to happen is, so we've got Vantage 4.0. It's in a pilot era right now. So what we now know is that there are 21 lenders that are adopting Vantage. Absolutely fantastic. But this list isn't public. The 21 lenders adopting this is not public. So the only two that we are only aware of PennyMac and Rocket Mortgage. So they're actually the two of the largest mortgage companies in the country. And so just know those are the only two that have been made public that we are aware of that have adopted VantageScore 4.0. So understand, it's up to the lender as to if they actually utilize VantageScore 4.0. So it's not something that you get to choose. You can't say, hey, I want you to score me underneath Vantage 4.0. So if your lender has adopted this, great, then they can utilize that. So what you need to know, if you are wondering if the lender is using VantageScore 4.0, here's what you're going to do. You are going to pick up the phone and you're going to ask. It really is that simple. So the exact questions you're going to ask your lender are you currently participating in the Vantage 4.0 pilot program through Fannie Mae or Freddie Mac? Question 2, which credit scoring model will you use to evaluate my mortgage application? If you're not using VantageScore 4.0, when do you expect to adopt it? So what you want to pay attention to, and this is really important, pay attention to the answers of your lender, because I work with thousands of lenders and all lenders are not the same. You would be mortified, some of the people that I do not work with. And I'm going to leave it at that for now, because that's actually another topic for another time. But you need to do your due diligence when you're shopping for a lender. And I'm going to tell you, so when you are shopping for a lender, you have what's called a shopping window. And so the shopping window, it's actually 45 days under the older algorithms. If you're using the newer ones, it's going to be 14 days. Okay. You need to know this. It can be verified at the CFPB website. So you have 45 days to go from lender to lender to lender to lender. And it's only one pull, right? So it's 2 to 5 points of mortgage pull. It's extremely minimal, right? So do not be afraid. If you meet a lender and you're talking to them and you feel uncomfortable, go to the next one with absolutely no questions in your mind. Is this going to impact my credit negatively? No, it's not. You have 45 days to find a lender that you feel comfortable working with, okay? It's only going to impact your score one time. Now, for my lenders, okay, so if you actually want to get into the pilot for Fannie Mae, you can submit your interest online and you can go to fanniemae.com or just contact your Fannie Mae representative directly. And for Freddie Mac, just call 1-800-FREDDIE. So what's going to happen is the broader market is expected to open up through 2026. But in this moment, you really just have to ask. So that way, you know, right, who's a lender. And as soon as I get information as far as who's public and who's doing what and who's doing this, I'm asking everyone, trust me, I will let you know. So the interesting thing is I got asked the question, is this going to cause another housing crisis? I got asked this question by Fox Business because, right, 2008, 2009, the collapse was big and it was real, right? But you need to understand what happened in 2008 and 2009. So nothing collapsed because of an algorithm or a scoring model. It was caused by sloppiness. So what was happening is lenders were handing out loans with no documentation whatsoever. There was no income verification, no underwriting. And they were giving out mortgages to people who weren't qualifying for them. Well, understand this, like mortgage companies don't hold on to their loans, they sell them off, right? So these were sold off to Wall Street with zero repercussion, right? So the lender had zero skin in the game, right? They're selling off their loans, they're getting paid. Wall Street's taking on the loans and others as well. And there were all these loans defaulting. And so what happened is again, there was a massive collapse. It just came from sloppiness. So understand, so there's all these rules that went into effect, right? So the system does not exist today, right? That existed then. This is completely different. And just remember, systems are everything. So if you don't have a great system in place as a company, as an organization, you're going to fall, right? If there's no guardrails in place, no guidelines, right? People are just going to go and do whatever the heck they want. And so that ultimately is what happened in 2008 and 2009. So understand at this point, right? Do I think they're calling it more lenient, where I would actually prefer to call it more inclusive? So depending on who you talk to, right, someone would say, oh, this is a more lenient scoring model. I would beg to differ because at the end of the day, right, remember, there's still underwriting in process, right? And we actually don't know what exactly these scoring models are going to do, right? Because we don't have enough data yet. But what they're saying is the proverbial they is the intent behind these is to get more people approved while also mitigating the bank's risks at a even higher level. So more people get approved and even less people should default. So that's the goal of it. So next we have FICO 10T, right, that's coming down the pipeline as well. It has not been implemented yet. So it has been approved. Remember, it has been approved, but it has not implemented. So we'll get into FICO 10T later. But again, FICO still is a contender. So T stands for trended credit data. So trend credit data, again, this is not new. This has actually been a part of the mortgage underwriting process for a very long time. So trended credit data is not new, but it's going to be incorporated into credit scores now. So it should, again, hopefully help to really get a better picture of what a person is doing, right? So if you have high balances, let's just say for the last 2 years, and all of a sudden, boom, you pay everything down, right? Someone like that would traditionally, under the older scoring models, their scores would shoot up and potentially you would get approved. Potentially. And then now with these newer scoring models, someone like that they would be questioned, right? The algorithms would pick up the last 2 years of behavior has been risky, right? So someone who is traditionally a little more risky on paper for a long period of time might get denied, whereas someone who has traditionally been very steady and stable, right, they actually would potentially get pushed through. Because right now, someone who, let's say, misses a payment, who's never missed a payment in their life, the event is catastrophic. I mean, the statistic I give is if you're at a true 850, 130-day late, you can see your scores drop as much as 180 points if you miss one payment on a credit card. And that sits on your report for a full 7 years. So what I want to make sure everyone understands from this podcast is I don't want you to get caught up in chasing gimmicks or chasing trends, right? I just want you to understand what is happening, and you need to be aware and informed that in order to be successful in any mortgage climate, you need to know, right, where your scores are at, and you need to build timeless habits. And again, I just got off of another podcast where I talked about the importance, again, of not missing payments. I just said it again here. I'm going to reiterate myself until I'm blue in the face, because this is what keeps people stuck and broke, right? Your credit score is attached to everything you do. And right, when you get a mortgage and your credit score is subpar, you are just literally giving money to the bank because you refuse to fix what's on paper, right? So, right, the lower your credit score, the more you give to the bank just because you look risky, right? The better you look on paper, the more contribution you make towards the purchase of your home, your car, whatever it is, right? Because interest rate. So one of my favorite quotes is, those who understand interest earn it. Those who don't pay it. It is up to you to understand your credit score, to be in control of your finances, and to build any sort of real wealth, right? No one is going to do this for you. You have to learn. So with these new algorithms, right, popping out, right, be aware, right? If your score is not in those premium tiers at 760 or higher, you're overpaying literally for everything you own. And that includes homeowners insurance. Homeowners insurance has gone up 11% in the last year. And if you have bad credit, car insurance, homeowners insurance, it's going to cost you more. They are saying that people are being priced out of homes not because of the cost of the home, but because of insurance and taxes. So you have to factor all of that into the equation when you are looking for a home. So what I want everyone here to understand, the opportunity got bigger yesterday. The bar did not get lower. And I actually think that's a wonderful thing, because it means more people who have been doing the right thing, paying their rent on time, staying consistent, and building quietly are now going to have that opportunity to be seen. So with that being said, that is a wrap. So please like the show, subscribe, share this with anyone that you think needs to hear this. And guys, God bless. If there are other things that you want me to talk about, please message me and we will consider putting it into the podcast. Thank you so much for listening today. I hope this helped, and God bless. Thank you so much for listening to this podcast. If you enjoyed this episode, please hit like and subscribe. And if there's someone you know that this would help, please share this with them. If you are looking to fix and repair your credit, you can find us at www.micaabigail.com. And if you're looking for more personal stories on myself, you can find me at Fit Credit Doctor. Thanks again for joining, and God bless.